Then in our second bucket, this is going to be our moderate bucket. And this bucket is going to be focused on income. And because it's my moderate bucket, I know that the market is going to be a little more volatile than my cash bucket, but not so volatile that I need 5 to 10 years for it to recover. Then that's normally going to be when we're talking in the stock market. Normally, when we talk about the stock market, we're investing in assets that we're comfortable waiting 5 years. We're not day trading. We're not trying to figure it out in the next 5 months. We expect these to be good choices for 5 years. Does it mean that we will sell these assets if the market changes? Of course. If information changes, we can update our analysis. But when we chose the stock in the early going, we believed it was a good investment for the next 5 years. And so normally that means that we need to be somewhere around 3 to 8 years for this bucket. Because if there is ever a particular time that our income-based assets don't perform well, they normally don't need that much time to recover. So if our most aggressive assets, we want at a minimum 5 years, this asset could be 2, 3, 4, it could be right around there, but we're going to be a little bit more conservative. And so then the idea for this particular bucket is my income-based asset. So that's going to be bonds. And so normally we're talking about the bonds. These are probably going to be a little bit closer to the short-term bonds. So we're talking about normally under 8 years, right? So we're going to have bonds. This is debt. We can get treasury bonds from the government. We can get corporate bonds from a corporation. But the idea is that we're choosing very safe bonds. We're not going for penny stocks or aggressive ones, high yield bonds, which is what we renamed junk bonds, which is messed up, I know. But we're not going for high yield junk bonds. We're going for nice, successful companies with good credit, investment grade bonds. And then we're normally going to build this bucket with those. We would then be also considering things like a value fund. All we're saying when we talk about value funds is these companies already have the value. We're not investing in growth like, I don't know, I hope it works out. When you're investing in value, what we're saying is this company has already done it. It's a very successful company and we're getting it at an okay price. And so we get at an okay price. We're not going to get a great return on this, but the idea of this bucket is to keep up with inflation. If I can keep up with inflation, if I can get around a 3 to 5% return from this bucket, I normally feel pretty good. And because I'm just trying to match inflation, I'm able to maintain my lifestyle in many ways with just this bucket.